Hi, welcome back to the channel. In today's episode, I want to give you an important update on what's happening in the United States bond market because over the past few days we've seen something very unusual happening. The US Treasury has effectively stepped into the bond market in an attempt to bring long-term yields back under control. And initially, that strategy appeared to work. Bond prices jumped, long-term yields fell sharply, but that relief didn't last very long. The bond market has started fighting back. Yields have moved higher again, and perhaps even more importantly, something else has now started moving in the opposite direction: the US dollar. The dollar ended the week under pressure and has fallen to its weakest level against the euro for around 3 months. And there is now a growing debate amongst investors about whether the attempts to suppress US borrowing costs could simply transfer pressure somewhere else, from the bond market into the currency. And that raises some really important questions about confidence in US assets, the enormous level of American government debt, and what happens if investors start demanding either higher interest rates or a cheaper dollar in return for financing the United States. And today I've got 3 really interesting charts to show you because I think when you actually see what's been happening to bond yields, the risk premium being demanded by investors, and the value of the dollar, it really brings the whole story together. So there's quite a lot to talk about. But before we get into all of the details, if you're enjoying these economic updates, can you please give this video a thumbs up? Please subscribe to the channel if you haven't done so already. Hit that red subscribe button. And don't forget, if you can see that hype button, the funny little symbol alongside from the thumbs up, then please press that because it will help me with the algorithm, promote this video to more people, and most importantly, put a smile on my face. So let's actually start with what's happened. Over recent weeks, we've been talking about the increasingly uncomfortable situation developing in the US bond market. Long-term yields have been rising, and the first chart I want to show you illustrates this very clearly. This is the yield on 30-year US Treasury bonds. Now this one's relatively straightforward. When the yield goes up, it means that investors are demanding a higher return for lending their money to the US government for 30 years. Bond prices and yields move in opposite directions. So when investors sell these bonds, their price falls and the yield rises. And you can see on this chart exactly what's happened. The yield has been moving higher and eventually reached 5.34%. That was the highest level that we've seen since 2007. So we're talking about borrowing costs at the long end of the US government bond market reaching levels not seen for almost 2 decades. And then look at what happened when Scott Bessent and the US Treasury announced the larger bond buyback program. The yield suddenly dropped. It fell by almost 10 basis points immediately after the announcement. But then look at what happened next. The yield started moving back up again. So visually, this chart tells us something quite important. The US Treasury intervened, the market reacted, but the relief was very short-lived. And that matters because we're not simply talking about bond yields moving around because investors think the Federal Reserve is going to change interest rates. There are now much bigger issues at play. And this brings me to the second chart. This one looks a little bit more complicated, so let me explain exactly what we're looking at before we talk about what it means. This chart comes from the Federal Reserve Bank of New York and shows what's called the 10-year Treasury term premium. Now, the easiest way to think about the term premium is this. Imagine I offered you 2 choices. You can lend somebody money for 3 months, or you can lend them money for 10 years. With the 3-month loan, you get your money back very quickly, and you can decide what you want to do with it next. But if you're lending for 10 years, there's much more uncertainty. Inflation could change, interest rates might change, government borrowing could increase, economic conditions can change, and the value of the bond can move substantially before you eventually get your money back. So investors might be saying, if you want me to lock my money away for 10 years and take all of that additional uncertainty, I want to be paid something extra. And that extra compensation is essentially the term premium. It's important to understand that this isn't simply the interest rate investors expect the Federal Reserve to set over the next 10 years. The New York Fed uses a model to separate those expected future short-term interest rates from the additional compensation investors appear to be demanding for holding long-term bonds. And that's what this chart is showing us. The chart goes back decades, which is useful because it gives us some historical perspective. There have actually been long periods when the estimated term premium was extremely low or even negative. In other words, investors were prepared to hold long-term US government bonds without demanding much additional compensation at all. Part of that was because US Treasuries were viewed as one of the safest and most desirable assets in the world. Central banks wanted them, as did pension funds and commercial banks. International investors also wanted to invest into them. But look at what's happened recently. The term premium has moved substantially higher. And I think this is one of the most important charts in today's video because it tells us that the rise in Treasury yields isn't simply the Federal Reserve might put up interest rates, therefore bond yields are rising. Something else is happening. Investors are demanding more compensation for taking the risk of holding long-dated US government debt. And that potentially tells us something about concerns over inflation, government borrowing in the US, the huge supply of debt coming into the market, and uncertainty over what US finances will look like over the next decade. The United States now has more than $40 trillion of government debt. Its budget deficit remains enormous, inflation remains a concern, oil and energy prices remain elevated as a result of the continuing situation with regards to Iran and the Strait of Hormuz, and at exactly the same time, America's biggest technology companies are borrowing enormous amounts of money to fund the artificial intelligence infrastructure boom. So there's effectively an enormous competition for capital right now. The US government wants to raise money by issuing more bonds. American corporations are raising for the AI situation. Other governments around the world are also raising money to fund their deficits. And investors are increasingly asking a very simple question. If I'm going to lend the US government money for 10, 20, or 30 years, what return do I need to be compensated for all of those risks? And increasingly, the answer coming back from the market appears to be, we want more. And that's why the 30-year yield has moved above 5%. And this is important because the US Treasury yields don't exist in isolation. They affect mortgage rates and corporate borrowing and credit and valuations in the stock market. And critically, they affect the amount of interest that the US government itself has to pay. US government interest costs are now running significantly more than $1 trillion per year. So Scott Bessent and the US Treasury decided to act to do something about that. The Treasury announced that it was going to double the size of planned buybacks of long-term bonds. Previously, these operations had been expected to be around $2 billion, but they're now going to be around $4 billion per operation. So every time they step into the market, they're going to buy $4 billion worth of long-dated bonds. And importantly, Scott Bessent has indicated that they could potentially become even bigger, these purchases. The purchases are aimed specifically at bonds between 10 and 30 years in length. So effectively the area of the market where the pressure has been the greatest. Now technically, this is being presented as a liquidity operation. The Treasury has been carrying out buybacks like this since 2024, but the timing here is important. This announcement came outside the normal quarterly schedule after long-term yields had surged to a 20-year high, which is why investors immediately interpreted it as an attempt to put downward pressure on long-term rates. And initially, as we saw earlier, the strategy worked. The 30-year yield did drop and bond prices rallied. The 10-year yield also fell. Stocks initially responded positively, but then something interesting happened. The effect started disappearing. Investors began selling bonds again. The 30-year yield moved back towards 5.25%. The 10-year moved back towards 4.7%. In other words, the US Treasury fired what appeared to be quite a significant weapon at the bond market, and the market absorbed it and then started moving in the opposite direction again. And that is potentially quite significant because the fundamental problem hasn't actually changed. Buying back some long-term bonds doesn't reduce America's budget deficit. It doesn't reduce the $40 trillion of debt, and the US government still has to fund itself. If the Treasury buys more long-term debt back, it needs to raise that money somewhere else. And the obvious solution is to issue more short-term Treasury bills instead. But there is potentially a consequence to that action. And this is where things get really interesting. Because if the market believes long-term US government debt should be paying 5% or 5.5% or potentially even more, but the authorities take action preventing those yields from rising, where does that market pressure go? Because it doesn't simply disappear. One possibility is that it moves somewhere else. And that brings me to our third chart. This is the US dollar index, normally referred to as DXY. And before we look at what this chart is doing, it's worth explaining exactly what this index represents, because when we say the US dollar is rising or falling, the obvious question is rising or falling against what? The US dollar index attempts to answer that by measuring the US dollar against a basket of 6 major currencies. Those currencies are the euro, the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. And they don't all have the same weighting. By far the biggest is the euro, which represents around 58% of the index. The Japanese yen accounts for 14%, the British pound around 12%, and then you've got the Canadian dollar, Swedish krona, and Swiss franc making up the remainder. The index was originally created in 1973 with a starting level at that point of 100, so that gives us the benchmark. If the index is above 100, broadly speaking, the dollar is stronger against that basket than it was back in 1973. But if it's below 100, then it's weaker. Now my chart here shows the last 3 months, so we're not looking all the way back to 1973, we're deliberately zooming in on what's happened recently. And look at the direction of travel. The dollar index has been moving lower. Following the Treasury announcement, it suffered a particularly sharp fall, and it finished the week at around the 99 level. Now, once we clear here, the US dollar isn't collapsing. This is not a currency crisis. I don't think we could accurately describe it as a crash, but what makes the move interesting is what's happening at exactly the same time. We've got concerns about US government finances pushing long-term bond yields higher. We have Treasury stepping in with larger buybacks designed to take some pressure off those long-term borrowing costs. And at the same time, the dollar has weakened. Against the euro, the dollar has fallen to its weakest level for around 3 months. And that's led to a much more uncomfortable phrase starting to appear in financial market discussions: dollar debasement. Now, we're going to talk much more about that separately because I think it deserves its entire video of its own. But the basic argument here is really interesting. If investors believe the market clearing yield on long-term US debt should be higher than where it is, but policymakers deliberately suppress that yield by buying more of those bonds, creating demand for those bonds, investors may demand their compensation somewhere else. And one way that adjustment can take place is through the currency. Instead of getting a high yield on the bonds, you get a weaker dollar. And there was another fascinating market reaction after the Treasury announcement. Gold jumped by more than 3%. Bitcoin also surged. And that's interesting because both of those assets are increasingly viewed by some investors as alternatives to traditional government-issued currencies. If investors become concerned that governments are effectively manipulating borrowing costs, increasing short-term borrowing, and attempting to prevent markets from setting long-term interest rates naturally, assets outside of the system can suddenly become more attractive. And there's an extraordinary comparison developing here with Japan, because only a few weeks ago the United States did something highly unusual. It joined Japan in intervening in the foreign exchange market to support the Japanese yen. That was the first joint US-Japanese currency intervention since 2011, so 15 years. The yen had fallen to levels not seen for decades, but Japan has another problem. Its government debt is enormous. Japanese bond yields have risen substantially, and that matters enormously to the USA because Japan is the largest foreign holder of US Treasuries. Japanese investors have historically bought huge quantities of American debt because US yields were considerably more attractive than yields available in Japan. But if Japanese bonds suddenly offer much higher returns, why take the currency risk of sending money to America? And there was another fascinating detail in the recent yen intervention. The United States reportedly sold euros rather than dollars when buying yen. One interpretation of that unusual decision was that Washington did not want Japan funding its currency intervention by selling huge quantities of US Treasury bonds, because that could have made America's bond market problems even worse. So all of these seemingly separate stories are actually starting to connect. Japan's bond yields are rising, and America's bond yields are rising. The term premium being demanded on US Treasuries has risen. The US government is clearly concerned about long-term borrowing costs. The Treasury is increasing its purchases of long-term bonds. Washington has recently intervened in the currency market, and now the US dollar itself is weakening. And ultimately, this all comes back to one thing: confidence. America can unquestionably issue more dollars. Its debts are denominated in its own currency, but that isn't really the issue here. The question is, at what price will investors continue financing it? Will they demand a 5% yield, or is it 5.5 or even 6%? Do they demand an increasingly large term premium for holding that debt? Or do policymakers suppress those yields and investors instead demanding compensation through a cheaper dollar? That's why I think what happened this week is so important. Scott Bessent's intervention demonstrated the US government is clearly paying very close attention to long-term borrowing costs, but the market's response demonstrated something equally important. There is a limit to what technical interventions can achieve if the underlying fiscal problem isn't dealt with. You can buy bonds, you can issue more Treasury bills, you can intervene in currencies and change the shape of the yield curve, but none of those things by themselves reduce the total amount of debt. They don't eliminate the US government deficit, so the next few weeks will be extremely interesting. If long-term yields continue moving higher despite Treasury intervention, the market may effectively be challenging Washington to do something bigger. But if Washington does something bigger, the consequences for the US dollar could become significant. And that is the trade-off I think we need to be watching: higher US bond yields or potentially a weaker US dollar. And in the next video I'm going to look much more closely at the whole idea of dollar debasement, why investors are suddenly talking about it, why America is increasingly being compared with Japan, and whether we could actually be witnessing the early stages of a fundamental shift in the way global investors think about US government debt and the US dollar. Because if that is happening, the consequences would extend far beyond the bond market. So hopefully you've enjoyed today's video, you found it useful, informative, and most importantly, thought-provoking. If you've liked what I've said, or maybe you didn't like it, but you thought it was interesting, then please give me a thumbs up. Please subscribe to the channel if you haven't done so already. If you have the option and you can see that hype button, then please hit that because it will help this video. Thank you so much to everybody for watching this video all the way through to the end. And also, thank you so much to everyone that's supporting me. If you've bought me a coffee or sent me a YouTube super thanks, thank you so much for that. And if you're a long-term supporter, either through YouTube membership or Patreon, thank you for that long-term support. That's the thing that really keeps me going and making more videos. So really appreciate it. And if you're looking for a smile on your face, then check out one of the jokes that I posted recently because hopefully that will make you laugh.